Good day, friends. This video I would like to dedicate to modeling option strategies and working with the what-if scripting. I will tell you how to run this scenario in the web terminal and desk terminal. We will work with different asset prices, different time intervals, and different volatility levels. How to model strategies. I get this question from viewers quite often. I'm going to answer it now. Watch this video to the end to see the full range of functionality of the what-if building. I have an option board open, a quarterly option series selected, and now I'm going to build one simple strategy. The Bitcoin futures price is around 27,000. And for example, we want to sell 1,000 put options at strike 26 and 1,000 call options at strike 29. After selecting the options, I click on the View Chart button. And we can already look at our option strategy. You all know that this strategy is called a salt triangle. What's going to happen to this triangle over time? We can see it by looking at the P&L time curves. They're displayed here, and you can see sort of clues here. It says what's going to happen on a certain date, what's going to happen today, what's going to happen a week from today, and so on. If the price becomes 26,000, then today we will get a P&L minus $329. And on expiry date, we will get a positive P&L and a profit of $294. There's a built-in what-if scenario here. At the bottom, we have a curve legend. The thinnest line indicates the current day. The bold line indicates the expiration date. The symbol is red. But we can model by setting our own asset price. How? We need to turn off the online mode, and then we set our price. What if the price will be 28,000 on the calculation date, where we select, for example, a week from now? As you can see, the chart has recalculated. P&L has changed. It became 215. The futures price is 28,000. This shows the price at the current moment, but I'm just saying it in case you didn't know. But at the price of 28,000, P&L will be equal to $215, which is our profit. Delta will become minus 136. Gamma and Vega will also change their values. So, we have considered the scenario what if the price will be 28,000 in a week. As you can see, it's very simple. Don't forget that we can add futures here, BA shares, where we can set the number of futures and the price for which we bought or sold them. If the futures are bought, long position, we set a positive value. But if the futures are sold, short position, we will write a negative value. And we can see what possible financial result of this strategy we will get and what will be the margin requirements. I think that everything is clear. But don't forget, in order to switch to the what-if mode, we need to uncheck the online box. I will return to the online mode through this checkbox. The current market values will be returned. See? All market values are back. All calculations at the last price of the asset. I almost forgot an important thing. If you want to run your scenarios through your volatility curves, in this line you can select a volatility curve that you have created. For example, position IV. The values in position IV are not set correctly and kind of small. But remember that you can do all the calculations on your own volatility curves. Let me demonstrate this. I'm opening the Bitcoin volatility curves, volatility chart. Here they all are. Next, we select an option series. For example, position IV. You can use any curve. Let's imagine that volatility goes down. For example, it's going to be 29. It's going to be shaped like this. We can save this volatility curve on the server by pressing Save button. And then we can use the curve in our scenarios. In this window, we can change the volatility curves. And after selecting position, the P&L chart has changed. You can change the curve right away in this window. Let's say if it goes up, it becomes 38. After I click Save, look what happens. Because of the high volatility, we get a significant loss. Okay, let's try to model what happens 3 days later. The time decay will give us a profit that will cover the Vega loss incurred. Almost. I recommend using offline modeling to study option strategies and evaluate risks and returns before opening positions. And after opening a position, you will be able to model and make a decision. Maybe it's time to close this strategy. Maybe it's time to lock in a profit or losses if the risks have been realized. And that's all for the web terminal. And now let's move on to the desktop terminal. Let's create a similar strategy. Strike 26 and 29. Same strategy. Sell 1,000 options each, 1 Bitcoin, long and short. I recommend clicking on the T price button to bring all prices to theoretical values. Let me enlarge the picture to make it clearer. How to use the what-if scenarios here. First, let's pick an asset price. For example, 28K. I am now modeling what if the price is 28,000 and I choose a date, also next week. P&L is 216. The Greeks look like this. In the desktop terminal, there are more possibilities for modeling because we can also calculate rolling options. I have demonstrated this in some of my previous videos. We can also use Shift IV here. Okay, I'm going to go back online now. Look, 0. Current volatilities are set. Exchange. And by changing the Shift IV, all the data for the put and call options will change. Let's say here 33, 34, and I change the Shift IV to 5, and then we get 38 and 39. And we can immediately see what happens to our chart if the volatility jumps 5% or goes down. This is the line where you can check all the data of your strategy. By moving the cursor around the chart, for example, I'm now at 28, and in this line the data changes as you move your cursor. It's very convenient. Here you can also change the volatility curves, volatility and position volatility. If the Bitcoin price falls, then by changing the data in the close price line, you can buy back 10 put units. In this case, the profit on this option is fixed, and only the put options remain. As a reminder, after pressing the GM button, the margin requirements are recalculated. In the close price column, I will again write 0, as if we do not sell anything. And let's continue with modeling. Let's say we sell 1,000 contracts of Strike 29. Or not 1,000, but 500. Okay, 500 options at a price of 20. As you can see, you can simulate all kinds of scenarios in the AE terminal. The possibilities are very broad. This is financial engineering that you can use to make a profit. And that's all for now. If you liked this video, leave a like, subscribe to the channel, leave your comments. I wish you all the best and successful options trading.